Welcome, friends, to this month's edition of Tax Gurukul. It is an BCAS initiative, and we have been doing on a monthly basis. This month, I am going to speak on certain circulars, notifications, and certain recent decisions which have been ruled in February 2019. Okay. To start with, there is this task force which was set up in around 2017, wherein a new draft of direct tax laws was required to be done. A committee was set up uh, to revamp the entire tax law, and a task force was set up. They had been given a deadline to give their first draft, and the deadline expired on February 28 of this year. However, they couldn't present the draft, and that is why the CBDT member and the task force committee member had asked for an extension. So a further extension has been granted for 3 months, and it has been extended till May. So they have to now provide the new draft of the legislation by May end. These days, CBDT is and the tax department has been unearthing a lot of bogus donations which have been claimed. So yet again there is one another racket which is being found by the CBDT, which is regarding a donation which is claimed under Section 3512. So Section 3512 is basically the donations which are made by the donors for using that donation for scientific research and development, and in return they get a weighted deduction. So earlier it was 175%, now it has been changed to 150%. So whatever you donate, you receive 150% as a donation to be claimed from your tax returns. The investigation wing has got a name of a society named Rural Development Society, which is situated in Hyderabad, and that society is claiming to be a society which is registered under Section 3512, which is actually fake. And it is been under the investigation and the survey operations which were carried out at the society premises. They had confirmed, the secretary of the society confirmed that these are basically fake, the donations, and they're not real. They give the donation certificate for a 5% commission. So CBDT has directed all the assessing officers and the principal commissioner of income tax under them to review all this donors. There's a list of more than 100 donors which is put in public, and recovery actions has to be taken against all of them to safeguard the revenue of the department, and it has to be done after a thorough investigation, and any other assessment years also which are involved with this assessees are required to be assessed based on these directions. Since long we know that there has been a debate on whether Aadhaar card is constitutionally valid or not. So it had been upheld by Honorable Supreme Court in September 18 that it is valid, and subsequent to that, the CBDT had given directions or a time limit for linking our PAN card with Aadhaar card in our database in income tax. So that had been extended multiple times, but now the linking is mandatory, and it has to be completed before 31st March 2019 by all the PAN account holders and the ones who want to file their income tax return online. So this press release was released on 14th Feb, stating this deadline, and so all the assessees who are supposed to file returns of income will have to mandatorily link their PAN card and Aadhaar card on the income tax database. We know that since a long time there is a lot of angel tax or tax on startups was in picture, was in news, and there was a series of additions which were made by the assessing officers on the startups, on the share capital which they have issued. So normally such startups issue shares so as to get funding, and that funding is used by the startups for the purpose of business. And there had been a lot of debate. So there is this notification which has been released by the government, and this is a very welcome provision. This is a welcome move because it is going to benefit a lot of startups in India. So they have basically increased the or enhanced the definition of startup. So earlier, a startup was considered to be there was a period for considering startups which was 7 years. So exemption was allowed under Section 80 IAC. There was a different exemption section which was allowed up to 7 years. Now they have enhanced that limit to 10 years. Another thing is startups were qualified only those companies which were below who had a turnover of less than 25 crores. That has been enhanced significantly to 100 crores. So this move is basically a huge move because uh, a lot of startups will be covered under 100 crores turnover, and it will benefit a huge startup companies. Again, this was the debate. There was a debate under Section 56 to 7. So this is a section wherein the any valuation of a startup. Whenever the shares are issued at premium, so that valuation, if it is less than the fair market value, the excess was taxed by the department as under Section 56(2), and here there was a lot of issues in the valuation. This entire thing has been done away now because there's a blanket exemption which is given by the government of up to rupees 25 crores. So up to rupees 25 crores, the valuation will not come into picture, and they will directly be allowed. There will be no tax which will be taxed by the authorities. So this is going to benefit, as I said earlier, and it is going to have a lot of positive environment around startups, which was quite negative in past 6 months. However, there are certain conditions for which are very few, but there are certain conditions for utilizing these tax reliefs. First is that the startup should be a private limited company, and it should be recognized by DPIIT. DPIIT is Department of Promotion of Industry and Internal Trade. So that is first condition. Another thing is there is one very simple self-declaration form which is to be filed by those startups on the website of DPIIT. So only once that is done, then the relief can be passed on. So once that has been done, that has to be forwarded to the CBDT, and the CBDT will give a tax certificate to the startups so as they can claim the relief under Income Tax Act. Another thing is that there are certain companies which are not allowed to use the tax relief who are into some specified assets. So there is a list of specified assets which is mentioned in the notification. So apart from any other ifs and buts, this is a wholesome law or wholesome amendment which has been made, and it is going to definitely prove a very good initiative for the startups. Now I move on to certain important case laws which have been delivered in February. And the first one which I have taken up for discussion is Supreme Court decision in case of Arham Softronics. So this is a decision on the deduction or the tax holiday which the assessee claims under Section 80 IC. So there is a tax benefit which is given to all those industries who manufacture in hilly areas like Himachal Pradesh or Northeast, and the provisions provide for tax exemption for 10 years. So the initial 5 years, there is this 100% of profits which can be claimed exempt, and for the remaining 5 years, 25% of the profits can be claimed exempt. So it can be throughout a period of 10 years. However, there is a definition under the tax law regarding the initial assessment year, and initial assessment year states that either it can be the year in which the factory is set up or manufacturing is set up, or it can be a year wherein a substantial expansion has taken place. So in this client, this assessee, there was the case that they had set up a factory and they started claiming 100% profits. Between the fifth year, after the fifth year, they also undertook substantial expansion, which took a lot of fundings and which took a lot of change in the plant and machinery, significant expansion. And considering that it was a substantial expansion within the definitions provided under the section, the assessee started claiming 100% from the sixth year rather than 25% as mentioned in the law. So the argument of the assessee was that since initial assessment year also includes substantial expansion, that is why the assessee can claim 100% for remaining 5 years also. Supreme Court held in favor of the assessee, stating that initial assessment your definition is very clear and it can occur multiple times between the span of 10 years. However, the company cannot claim exemption beyond 10 years because there is a standard limit under a particular section of the subsection of this section. Interestingly, this decision is quite relevant because there was an earlier decision of Classic Binding Industries, again of Supreme Court, consider of the same bench, wherein they had held that the assessee cannot claim 100% profits for all 10 years. So that decision is now reversed. In this particular decision of Arham Softronics, the Supreme Court admits that the earlier decision was a mistake, considering that they had not considered the definitions which were there in the section, and that is why that decision does not hold good, and this will prevail over that. This is a very recent decision of Delhi High Court, and this is regarding to stay petition. So this is a decision in case of Turner General Entertainment Networks India Private Limited. In this case, the petitioner's grievance was that stay was rejected by the principal CIT without even looking at the merits of the case. So, application was made to the assessing officer. Assessing officer rejected it, stating to pay a demand of 15%. 15% was demand percentage which was set up by a CBDT office memorandum in 2017. That has now been increased to 20%. And the assessee went to the principal CIT. Principal CIT also rejected the stay on the grounds that if the assessee is ready to pay 20% of the demand, in that case the stay will be granted. Otherwise, the stay is tend to be rejected. Against this rejection, a writ petition was filed by the assessee before Delhi High Court, and Delhi High Court has held in favor of the assessee, stating that the memorandum which the CBDT memorandum of the CBDT which the assessing officer is referring to is firstly binding only on the assessing officer, and principal CIT is not bound by such decision of the CBDT. Secondly, it says the circular or the memorandum is very clear, stating that the assessing officer has to apply his mind or ascertain whether a situation is falling less than 20% or more than 20%. So 20% is basically not a benchmark. It is not a standard payment percentage which is mentioned by the CBDT. It is at the discretion of the assessing officer, and the assessing officer is required to apply his mind before deciding on the application of stay of demand. So the assessing officer cannot consider this as a blanket percentage and reject the stay application. This is not a prerequisite, this is not a condition, and the assessing officer is absolutely required to apply his mind and hear the cases on the basis of merits of the case rather than just referring to an office memorandum given by CBDT. So this is going to help all those pending appeals wherein a huge demand has been raised. So if the assessing officer or CIT appeal makes a demand just based on this circular, it is our uh, duty, or it is our right to tell them to uh, adjudicate on the basis of the facts of the case. This is a very interesting decision which has come up by Bombay High Court. Every year, or rather, I may say every month, there are a lot of decisions which are taken against the reopening, which is done under Section 148. So here, there was the same thing. Reopening was done. There was already a regular assessment which had taken place under Section 143(3), and the reasons were issued to the assessee. The assessee objected the reopening, and the assessing officer rejected the reopening. Against this rejection, a writ petition was filed before Bombay High Court by the assessee. And the reason was stated that there was already a regular assessment, and the case was decided. The details which were in question were also examined by the assessing officer in the earlier assessment, and therefore this is just a change of opinion, and reopening cannot happen on the basis of change of opinion. High Court held that merely because assessing officer examined those transactions, that does not preclude him from initiating any subsequent inquiry or any subsequent additional information which is prejudicial to the revenue. Uh, Again, since at the regular assessment the details were inquired, were asked, and the disclosures which were made by the assessee were not true, assessing officer ruled considering the information was disclosed as true by the assessee. Since the information was not true, the assessing officer has all the rights to again reopen the case, and it made a very important comment stating that requirement of true and full disclosure is running throughout the entire assessment proceedings, and it does not restrict only till the filing of return of income. The assessee has to provide truthful details, and if it is not submitted, then the assessing officer can very well make a reopening, and it cannot be considered as reason, it cannot be considered as change of opinion, and it was against the assessee, and reopening was considered as good. Okay, now I take the decision of BLB cables and conductors. This was a decision of Kolkata High Court, and in this case, the assessee had returned a loss under commodity transactions, and this loss was considered as bogus and inadmissible in the eyes of the law by the assessing officer. The thing was that initially the loss was accepted in the return of income. Later on inquiry, the assessing officer came to know that the broker through which the assessee had dealt in these commodity transactions was suspended, or his name was expelled from the registry, and also that these transactions were actually not transactions in the name of the assessee but in name of some other party, and the bills which were provided, or the broker's note which were provided, all were forged and faked. These were the contentions of the assessing officer, and based on that, the entire loss was not allowed to be carried forward or to be adjusted by the assessee. In this case, the assessee proved that this is a loss, and further, the broker had recorded this particular transaction in his books of accounts, and had also offered the income as taxation. So it was held that to hold a transaction bogus, it is not enough that the broker has been expelled. The assessing officer requires a supporting evidence to disallow a loss or to treat it as bogus. The only fact that the broker was expelled, that itself does not mean that that is a criteria to hold the entire transaction as bogus. So this case law goes back to all of the case laws earlier which have been held in favor of the assessee, which states that the department needs to have certain concrete evidences against the assessee, that assessee has dealt into such activities. Only based on certain investigation reports, there cannot be a transaction which can be disallowed considering it as bogus. Okay, this is the last decision which I take up, and this decision is for the taxation of penny stocks. It is a Kolkata ITT decision, and in case of Mahavir Janwar, and in this case, the assessee had capital gains, which was claimed as exempt under Section 1038. It was a long-term capital gains, and it was considered a exempt. Now, the company in which the assessee had sold these shares and created a gain, that company was under the was in the name of certain investigation reports of the Department of Investigation of Kolkata. And since those companies were considered as penny stock companies, the assessing officer, based on that report, considered that this entire transaction is nothing but a penny stock transaction, and that is why the exemption cannot be given, and the entire sale consideration should be considered as income of the assessee, and it is considered to be bogus. In this case, the assessee submitted a lot of evidence and documentation. It submitted the broker's note, it submitted the bank account entries, the ledger accounts, and all possible documents which could be submitted for proving this transaction as a genuine transaction, against which the assessing officer could not corroborate the evidences which were filed by the assessee, and it was just made in addition based on the report which was obtained by the investigation wing. Uh, Here, the Kolkata ITD ruled in favor of assessee, stating that based on evidences which are submitted by the assessee, the assessing officer cannot, on probabilities or generalization or based on his own assumption, can consider this transaction as a bogus transaction or consider this transaction as a penny stock transaction. If the assessing officer wants to make an addition, the assessing officer also has to provide necessary evidences in support of their claim. The initial onus is proved by the assessee, and now whether that documents are submitted are wrong or right, that has to be proved by the assessing officer. Only once it is proved, the addition can sustain, otherwise the addition cannot sustain. And in this case, the case of the assessee was allowed. Thank you, friends, for listening to me. I hope it added value, and we hope you like our short videos. In case if you have any feedback, please post it on this email ID, and we would love to receive it. Please stay tuned for our next month's video edition.